Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Concerns about an AI bubble are dominating media coverage across platforms, and the big debate, whether we're actually in one. Our next guest argues the AI bubble narrative simply doesn't match the data. So what are today's underlying financial conditions showing us, especially compared to the dot-com era? And why is this distinction really the key to her thesis? Joining us here today to walk us through the data and what it means ultimately for investors is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. How are you today?
Hi, Pamela. I am well, despite the fact that it is not sunny in Boston.
It is not sunny, but I'm sorry to hear that. It's probably on the way, because I think we had that weather yesterday, blowing through some sunshine and cold. In any case, we'll invite everyone to send questions in for you over the next little while. We're absolutely going to ask you to walk us through what you do or don't see as too much CapEx and what that means for the markets. I wouldn't mind getting your thoughts, if you don't mind, beginning with the Supreme Court case that's going on right now. They've heard arguments. It's consequential for Canada, for other countries as well, to know whether the tariff structure, as we believe it is right now, is legal. What do you hear, and what could we expect?
Yeah, so based on history, again, that's sort of what I do, even with the Supreme Court. Based on history, you would say that oral arguments certainly give you a very strong hint of the way SCOTUS is going to rule. And it doesn't look like the administration will get all of their tariffs sort of through. So how much, from a magnitude perspective, is still questionable. I think that it is not likely that all of the tariffs stand. So some of the tariffs may stand. It's also unknown, what rebates will do. There were some questions over rebates. It's definitely possible that they could stay rebates in terms of not administer them. And we don't have any idea when the Supreme Court ruling will ultimately come down. There are some rumors that it might be before year end. That would be early historically. There have been some controversial cases where they wait to the end of the docket, which would be June. So again, a lot of unknowns on what the ultimate ruling will be in terms of magnitude. But I think it's important for investors to understand that there are other options for this administration to piece back together tariffs in a more cohesive policy structure. You might not get to the same exact dollar value, but there is one statute, and I'm not sure of the numbers with the section, that allows the administration unilaterally to apply 15% tariffs for 150 days. After that 150 days, it has to be ratified by Congress. In the meantime of that 150 days, there could be more Section 282 style tariffs that are along the lines of national security. So a lot of what we're seeing in the Supreme Court doesn't even apply to the tariffs we're seeing on autos, on copper, on lumber, all of those resource sort of driven national security 282 tariffs. So I think, when I look big picture, I think that when you add up all the tariffs, as much as we thought it was a massive change in global trade, it was still just a tax that wasn't big enough to tip the U.S. consumer into a recession. It meant less to the U.S. consumer than we thought, partly because we had so many tailwinds pushing the consumer forward. And that was even more true for corporate America, meaning the tax cut more than offset the drag from tariffs in aggregate, which is not to say there aren't winners and losers. So even if tariffs get pieced back together, I think what you might end up with is a situation where, yes, maybe there is a modest tailwind, but not a severe tailwind, but the decline in uncertainty from what might look like more cohesive policy than weekend tape bombs where investors are concerned might actually also be a bullish thing for stocks. So I don't think a whole lot changes, but I do think it reduces uncertainty, maybe going forward that's more positive. But I also don't think it's like the gift that keeps giving and all of a sudden tariffs and the tax associated with them are just going away.
That's so interesting that you think it may be more cohesive policy in the sense that it's sort of got a stronger foundation because it's law built in a way that is stronger. I mean, is that, it sounds like that could really create roots, which is good and bad from, I think, the Canadian economy perspective, but it's an interesting cohesive policy. Just tell us more about that.
Well, there's definitely other options, right? I think that the problem with emergency tariffs or that IEEPA structure is that everything seems like an emergency. So it's very difficult to get a read on what your business and supply lines and cost structure will look like. When you go through these other avenues, there is sort of more cohesive structure associated with them. certainly the 282 tariffs and even the 15% tariffs, so 150 days then ratified by Congress. So all of that looks more like something that you can get your arms around as a business. Remember, for corporate America, wherever, and really just corporations in general, once you know the answer, then you can plan. And I think it's really the struggle around not knowing the answer. Not that the answer is good or bad, but you need to know the answer and what this looks like on a go forward basis to plan. And then you can understand what your supply lines need to look like, what your cost structure needs to look like. So I do think it might end up just more sustainable. Like I said, I don't think tariffs are going away. You know, historically speaking, once a government gets their hands on some revenue, they tend not to give it up. So again, I don't think that all of a sudden tariffs are going to go away and then we're going to get these taxes back and rebates to the US consumer and this is going to be some sort of blow off top. I've heard that argument. That's definitely not my base case. Again, on the margin, I think it improves the risk reward on a more cohesive structure with declines in uncertainty and maybe a slight tailwind more than a headwind, which just means that numbers need to come up more for corporate America and that stocks are less expensive than you think.
Oh my goodness, that's so interesting, which ends up being possibly bullish. You'll tell us more about that. Let's go to the CapEx cycle, which is what we're going to talk about a bit more fulsomely here. Thank you for your commentary on that, because it gives us some brackets to watch whatever decision comes out with in the next little while. So there is CapEx and then there's CapEx. This is CapEx, the cycle is about growth companies, essentially making sure that they can pour money into a data center build out, essentially, an AI build out, a structure. Why is that different, for instance, growth companies going at this than, I don't know, when you think about utilities need to update themselves back through the 1980s or whatever, different types of clunky infrastructure that we think about as a CapEx cycle. What's different about it?
Yeah, all CapEx is not created equal, and this cycle is meaningfully different than the dot-com bubble, I would say. So look, I mean, I've seen a lot of data going around where people focus on, you know, 5 or 6 or 7 companies, the Mag 7, and you look over the last 5 years, and all of a sudden CapEx is growing exponentially from a hockey stick perspective relative to free cash flow. So all of a sudden, like when you narrow in your focus on that, it looks like a red flag. But when you back up and you look at, you know, really the forest, not just the individual trees, you start to see a bigger pattern. And when you add up all the CapEx and all the free cash flow in the Russell 2000 or Russell 3000, excuse me, so top 3,000 stocks across the universe, what you will see is this is nothing like we saw in the dot-com bubble. So if you look at the first chart, I think I have a chart. I don't always show my charts, but I think that you need to really see this visually. If you pull up the first chart of CapEx relative to free cash flow, you'll see back in that dot-com bubble, and really starting off in the mid to late 90s, you were seeing corporate America in aggregate spend 4 times, 3.5 to 4 times the amount they had in free cash flow on CapEx.
Wow. I mean,
where are we right now?
Wow.
Completely stressed. Where are we right now? CapEx is below free cash flow, right? So again, back to like starting points always matter, right? So that looks like egregious relative to history. Where we are currently doesn't even look egregious relative to the CapEx cycle we saw in energy infrastructure going into 2007, going into the financial crisis. So look, I think that this is just apples and oranges from, is this a CapEx bubble? Just when you look at the magnitude. And specifically for the technology sector, it's massively different. So this is, again, my lens is always on sectors, not just 7 or 8 companies, but on the entirety of the sector. If you look at the next chart, so the second chart, this is for technology as a sector specifically, and you'll look at the gray line is free cash flow,
on top
the blue line is CapEx, so these are log scale. So you can see in the blue line, you'll definitely see the hockey stick in terms of CapEx. And you could definitely narrow in on the last 24 months and say CapEx is growing like exponentially faster than free cash flow. This is a problem. But look where we were going into the dot-com bubble, where free cash flow was below CapEx for the entirety of that decade before. Where are we now? Free cash flow has been above CapEx for 15 to 20 years in the tech sector. which is a way to think about the fact that, look, it is very different. That doesn't mean there's ROI on every technology, but that difference matters because this time they have it to spend. And that is very different from what we saw in the dot-com bust.
Does it matter that the companies that are spending, that have free cash flow, that are pushing this forward, are what you'd like to call asset light? You know, they have people sitting at desks using computers. It's not heavy equipment, you know, that needs that type of CapEx. That said, these companies that have light assets, in some cases, are in fact raising, issuing debt to go and plow money straight into actually energy assets in some cases, like clunky infrastructure to take stuff out of the ground or to create a nuclear power outlet to plug in what they do at their desks for light asset work. I mean, they are actually pulling a couple of sectors together through some of this spending. Is that, I don't know, relevant, interesting, or just an aside?
Yeah, I mean, when you think about CapEx as a quant, like if you ask any quant on the street, if you find a quant on the street in Canada, just ask them, what do you think about CapEx spenders historically? They will tell you that generally speaking, high CapEx spenders underperform the S&P 500 or any benchmark over time. And it's partly around the mix shift that you just highlighted in terms of historically speaking, those CapEx spenders have been, you know, low operating margin, low PE businesses like metals and mining, like energy infrastructure, right? And they tend to overbuild in capacity. That's not true across the board. I mean, obviously that was true in the dot-com bubble for technology, but when you think that on average, CapEx spenders don't outperform, it's not 100% of them, right? So to the extent that CapEx is actually correlated with growth, profitable growth, that hasn't been a bad thing. Right? It's always about growth. It just tells you that most of the time in history, when people were spending a lot in CapEx, those are either in industries that don't grow or that the CapEx didn't relate to permanent growth. But back to it's different this time. And we can actually show a chart. If you want to show the chart, we can show the chart. But what is different this time is that what you are seeing, you can debate on future profitability, but I don't think you can debate whether or not the CapEx that has been spent to date has been profitable. So you do have to have a starting point that says, again, back to the, look, it's not the same kind of bubble. Right now, the fundamentals justify the valuation. If you go to the next slide, chart 3 shows you sort of the median earnings for technology.
Okay, so
right?
this
so
is,
you can see.
Okay, so sorry, I carry on. Yeah. I was just going
to say. So you can see how different this is for the median or average or however you want to characterize it, technology company. I know there's a lot of narrative around the fact that it's all just driven by 7 stocks. And look, I think that most of the time that can't be further from the truth. What you saw in, again, the 90s was that profitability for the median technology stock, and I could put telecom in here as well, peaked in 1996. Right, so there was this massive disconnect between operating margins basically declining, returns declining, median earnings declining for the median technology stock for 4 years before we actually saw the bubble. You're not seeing any of that right now. The average technology company is getting more profitable as they've been spending more on CapEx.
I mean, it is, demand is insatiable for companies that have everything from electricians to land to, obviously the chip story is there, but to build essentially the infrastructure, which is data centers, and putting everything together. And we haven't even begun to do that yet, have we? I mean, they're just getting the money pile set.
No, it is all still in some ways in the future. And that, you know, it's ironic because you always have these, you know, two things can be true at the same time. In the stock market overall, CapEx spenders tend not to outperform. But if you look at CapEx from an economic perspective, or again, we've sort of talked about this before, if I add up all the CapEx in the Russell 3000 and I divide it by sales and I call CapEx over sales growing, so CapEx growing faster than sales, and I call that a CapEx cycle, that's actually very strongly correlated with future GDP growth, meaning that it's quite good for economic growth and overall earnings growth. The debate is sort of whether or not it's idiosyncratically good for these 7 stocks. But those two things are true. Like, we can debate whether or not it's good for these 7 stocks. And what I would tell you is that historically speaking, to the extent that they are still profitable, it's not a problem for those stocks or those sectors. And overall, for the economy, it tends to be a good thing. And for overall earnings growth, it tends to be a good thing.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So we saw some wobbles in the stock market through this week, and lots of different comments on whether that's something coming, some volatility, a useful moment to buy, lots of different interpretations. But it followed on a week of earnings where we saw the big players, and as you say, it's many others than that, but we saw the big players confirm that they're going to, through their earnings calls and through their forward guidance and so on, spend more and dump much more money, at least for sort of the medium term, the next year or so through 2026, into exactly what we're talking about right now. So it sort of underpins the fact that the money is going to be sloshing around in the economy, and things in that sense should be fine for another year or so. I mean, do you feel like the narrative has shifted since the earnings calls wrapped up on some of those companies?
The narrative always depends on who you're talking to. And I've heard in our hallways, everybody is, I have an opinion on everything. So look, I mean, I think at the end of the day, stocks do not move in a straight line, and you always have to expect corrections as an investor. And we always say corrections are normal and healthy, and we always feel that that's true until they happen. Yeah. And then everybody panics because there's probably a reason, right, for the correction, or a rationale or a narrative around the correction. And maybe it's because of CapEx, or maybe it's because the Fed isn't going to be that friendly, or maybe it's because there's liquidity problems in the bond market. And where are we in terms of required reserves and an ample reserve regime? All of those things are debated. But to me, it always looks like the stock market does what the stock market wants to do, even despite the news, which is not move in a straight line. So remember, corrections between 5 and 15% happen in 60% of the years since 1962, but in 75% of those years, stocks end up higher by an average of 10 to 15%. So I think you always have to understand that there are corrections that are normal and healthy, even if there is some rationale behind why they're happening. To me, that's the math behind buy the dip. And when you have very visible earnings growth, and to me, again, I am not dissuaded statistically by valuation, when you have very visible earnings growth, I think you have a very strong secular risk reward with stocks. So to the extent that we do get a dip, I do think that the risk reward is still there for US leadership, specifically in technology.
When you go back to the research and all the work that you've done on median earnings and their growth, does that make a correction, in theory, less severe, or you're able to use it and it's not a falling knife? Does it make it a little bit easier to take? Because you've got a bunch of companies that maybe are medium sized and across the boards, with your ball in motion, that should stay in motion.
Yeah, no, median earnings is definitely the differential right now, where, again, we've been driven by cap-weighted earnings over the last 2.5 years, and median earnings is finally inflecting for the first time in 3 years. So we are emerging from the average stock having a contraction or an earnings recession. That usually is durable, and that is meaningful. Does it limit your downside? Not necessarily in terms of peak to trough declines. Always remember that, I was just explaining to one investor the other day, like, how to get your arms around like the average recession. And I showed him sort of an average chart of how stocks progress through recessions. And they were like, yeah, but that only shows like a 10% correction. And aren't recessions more like 35, 40? And I was like, well, some recessions are. But some recessions, especially on monthly data, are more like 10%, right? When you look at 1980, when you look at 1960, similar situations. So there's a variety of things that happen to stocks during recessions. And some non-recessionary bear markets are much deeper, meaning like 1998, long-term capital, the crisis like that, and even like the debt issues that we had in Europe in 2011. So recessions are non-recessions, but what you can see is when you have an underlying cycle, like a fundamental driver like earnings growth, any correction tends to be less persistent.
Okay.
It doesn't mean stocks can't go down 10 to 15%, but it's unlikely that they are persistently down if that driver is intact. So again, you can always expect volatility, but I think that persistence in terms of loss is much more bolstered by the fact that you have the average stock now growing earnings faster than it was 6 to 12 months ago.
So with that said, and maybe taking a look at using a correction as an opportunity and so on, does it also then mean, though, that if there is going to be a correction, that things are a little expensive right now? Or does that go back to expensive is okay if the earnings growth is there, essentially?
To me, expensive is always okay if the earnings growth is there,
Okay.
right? And expensive is just a reflection of the fact that earnings growth is visible. And that's why you get these weird, strange correlations with the more expensive stocks or sectors are, the more likely they are to outperform over the last 20 years, because it's the secular trend of profitability that actually matters much more than the starting point on valuation. The ending point on fundamentals, remember we talked about this with Kate measures,
Yes.
The ending point in terms of where you end with the cycle is more impactful, which is not to say that it's the only impact, but more impactful than the starting point on valuation. Even when you think about the dot-com bubble, right, the starting point in terms of valuations was, I think, almost double where we are now in terms of the median stock or cap-weighted stocks, and then the relative valuation of the technology sector, right, double where we are now. But the ending point was almost more important because operating margins almost went negative and net margins went deeply negative, right? So it became from, a profitable sector to a deeply unprofitable sector. Right now, technology is on a secular basis been more profitable cycle to cycle, and operating margins are continuing to expand. So once you have those fundamentals in place, again, it looks like to me, when I look at all of the data, things are expensive for a reason. And right now, I think technology is proving that point.
The sector, we started out talking a little bit about what those with lots of free cash flow are investing in, and it's versions of a data center build out. There are other ways of looking at it too, and other things they're spending on. But with that said, are the sectors, which you look at much of the market through sort of the lens of sectors you're saying, are they shifting? Are they changing? They do change sometimes.
Oh, without a doubt. Right. I mean, and sometimes Kix changes them too, which changes the way I talk about them. I mean, really, communication services, we always had the old telecommunication services sector. And then many tech-like companies like Meta and Google are actually now in comm services. Right. So, and, the way we structure and think about that does change on a go-forward basis. Right. Healthcare is a little bit more unilateral. Energy is a little bit more unilateral or cohesive. But you definitely see shifts in terms of sectors along the margin, financials and technology. What's a fintech? What's a tech? Right. So there is always a debate in terms of the cohesion of sectors and how they shapeshift through technological advancements that change how they're either consumed or supplied. But if you want to sort of think about just how shifty environments can be with a new technology, if you say that the dot-com bubble will have the starting point in terms of when Netscape hit, and if you say our AI, I won't call it a bubble, but our AI CapEx driver is started with OpenAI, with ChatGPT, with the launch of ChatGPT. If we think we're in similar cycles, what you would see is where we are right now relative to the dot-com bubble. Google wasn't even a company, and Mark Zuckerberg was in middle school. Right, so the ultimate winners and losers of this technology, and if you all like that, that's actually not my quote. If you like the ultimate winners and losers, we don't even know who they are yet, right? And we don't know what sector they will even belong in yet. So you do have to stay humble, certainly, about what might happen given the new technology and the shape-shifting as it relates to sectors and what they might end up as being.
And so for investors that want to take a look at certain types of sectors, get access to things maybe through a sleeve, what do you say to that? I mean, the answer is probably being very careful and making sure that you have a diversified portfolio with lots of stock picking within it. But I'm just curious, how should you start to think about sectors a bit differently in terms of your investments?
Yeah, so whenever I think about like how I like to either shape shift with or without this, I'm looking at the data that I'm seeing historically. You guys don't have the same data that I do, but we have data going back to 1962. That's why I'm very comfortable talking about the technology sector, because we have data that adds up all of those companies for whatever I'm looking at in terms of valuation. When you start to see divergences within either the industries of the sectors or the sector itself, right, like consumer staples, massive divergence relative to what we experienced in the 1980s when they were growth companies. When now they are not growth companies this cycle, you have to evaluate the fundamental shift in an individual sector of what it means now. So what I'm looking for in technology, remember I'm a technology investor, so you can either buy actively managed technology funds that are benchmarked against the technology sector or ETFs, your choice. That's sort of what I focus on in Denise Chisholm's sort of PA or in Denise Chisholm's pilot, which I signal to our diversified PMs. I focus on that section because I have the historical data. And to the extent that the historical data, the fundamentals match the valuation, that's when you still see a positive risk reward. When you start to see divergences, then there's another potential way to analyze it.
Okay, which is what?
Which is thinking about how differences matter more than similarities.
Okay.
So history can be used both ways, right? You can look to find patterns that are similar, and then you can look to find differences and see if those differences have had a meaningful impact on performance.
There's a great question that's come in. You've addressed part of it, but I think just come back to it. I think it really is on everyone's minds. What are your thoughts on companies investing in building data centers and reporting higher revenue despite operating at a loss? Wait, hang on a second here. Yeah. Just, I guess they need to get their SG&A in order, basically.
Well, what you are saying is, at least in aggregate, and certainly for the companies that are announcing a lot of CapEx, is that they have their free cash flow currently. Yeah. Whether or not the incremental profitability of that data center, I think that it'll depend on sort of the accounting associated with that. Right. But right now, again, we can debate the ROI in the future. Right now, the CapEx that has been spent to date has been profitable, meaning that you're seeing a correlation between better earnings growth and more CapEx. The persistence associated with that, I think, is still up for debate. But I think what's not up for debate is that these companies have it to spend right now. And that creates less problems than we've seen historically in bubble-type markets. So right now, we are being driven by a fundamentally justified cycle. And I think that that's massively different in terms of the risk reward when I hear people talk about, well, this is another bubble and CapEx is too far too fast. When you have the ability to spend on a new technology because you've been generating free cash flow in excess of what you need for the last 15 years, then the market gives you a free pass for a time to see if those profitability streams still hold up.
Just quickly, do we see some of that spending? Okay, data centers, we've talked about that for sure. Mm-hmm. The companies that have this money to spend, they're going to spend it, they signal they're going to spend it. Do you have an idea of how much consolidation that'll lead to? So large company, lots of free cash flow, willing to deploy CapEx, just by gobbling up a lot of companies. I mean, we have seen announcement of a number of those deals or different types of partnerships that are similar to that. Or is it a bit more, we're going to invest in sort of the picks and shovels? Is it a wholesale takeover of some of these companies out there that will help them build out? Or is it a bit more investing into companies and then, working with partnerships? I'm just kind of curious the nature that you think we might see.
I'm not close enough to the data, but I think it's across the board, right? Okay. I think it's every and all based on the dollars that we're seeing. From my perspective, when I look at it from a GDP perspective, what you saw was, again, CapEx, as the GDP accounts, was pretty escalated and elevated in the dot-com bubble by about, I think it was only 5%, 5 to 7%, depending on how you calculate it, of GDP. And as much as we've sort of declined, obviously the dot-com bubble deflated from a stock market perspective, yes. But spending in terms of CapEx, if you look at that, what I'm calling sort of that infrastructure spend, has remained fairly constant. And it's shifting up again, but that doesn't mean that it can't grow even more. So again, back to can the data help us? Am I seeing anything anomalous in the spend, either in corporate America, their own profitability, or in the GDP accounts? And nothing right now looks particularly anomalous, which means that I think your base case has to be that it's more sustainable than I think people expect. And again, to the extent that that sustainable CapEx is also profitable, and this is a positive environment for technology stocks still.
Fantastic. Denise Chisholm, thank you so much for setting us on that course and bringing that data and research work to us. We appreciate you sharing it.
Always great to be here.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.